Where we are in this bubble, I think we're on the verge of it beginning to collapse. The bubble is really quite simple. You never have an even increase in the amount of credit in the economy. And, when things look sort of better, banks tend to increase their balance sheet leverage by creating loans, which creates credit in the economy. And there comes a point where that gets a little dangerous, and then banks think, well, we've got too much risk on our balance sheet. And the two ways in which they can compensate for that, basically, are to lend money to the government rather than the private sector, and also to increase the rate, the interest rate, which they request private sector actors to pay. And that leads to, if you like, a turnaround in the economy. So, you have an economy which, is expanding, and then suddenly it starts contracting, as it were. Contracting in the sense that because credit is redirected towards government borrowing, you find that, the private sector ends up in trouble. Now, this is a cycle of bubbles which has been going on since the 1980s. And particularly, none of the bubbles have been allowed to wash out the malinvestments, the zombie companies, the companies which shouldn't survive because they don't actually produce what consumers want profitably. So those are the companies that should get wiped out every time the bubble bursts, as it were. But the bubbles haven't been allowed to burst. Each bubble has fed into the successive one. So each bubble has got bigger and bigger and bigger. And we saw a very big bubble accumulate by the time 2008, 2009, sorry, which manifested itself in a property crisis. That bubble was never allowed to burst. I mean, the Fed sat there with its checkbook and said, right, open check. Anyone who needs money, we'll give it to them. And it was followed by crises in Europe. You had Cyprus, you had Greece, you had, all these things started going horribly wrong. And again, the ECB said, whatever it takes. That was Mr. Draghi's mantra. So what we now have is we have the accumulation of all these bubbles into one big bubble. And the symptoms of it are really quite clear. I mean, you look at the valuation of equities on Wall Street. They're chasing the Magnificent Seven, the big tech stocks, on a momentum basis, not on a value basis. I mean, if value came into it, you'd be selling Tesla, for example, because Donald Trump's turned around and said, I don't go for this climate change rubbish. We're withdrawing from the Paris Agreement. Furthermore, we're going to hit China with tariffs. Where are Tesla made? A lot of them are made in China. That market there is diminishing. That's a stock that should be sold under any normal value judgment. But instead, it's at an all-time high. I think it will be sold. Of course it will. But so you can see that's an evidence of a bubble. There's a bubble, if you like, in the equities. And certainly, given that bond yields have already risen, this means that the valuation basis for the equity market is now more stretched than it was in the dot-com bubble back in 2000. I mean, that's quite something when you think that the behavior of people in that dot-com bubble was absolutely extreme. So that's one aspect. Another aspect is the cryptocurrency phenomenon. I mean, Bitcoin. They're going up forever. What are you buying? You're buying some digits. I mean, we had. You could buy these sort of I can't remember what they were called, but it was sort of electronic art. It wasn't even that. I can't remember what they called them, but people were paying silly money for nothing, and that's a sign of excess credit. And this is why you have inflation in the system. I mean, by inflation, what we mean actually is a decline in the purchasing power of currency, and that's going to continue. So as to where we are in this bubble, I think we're on the verge of it beginning to collapse. I mean, I think it's topping out. What will make it collapse is the next rise in bond yields. At the moment, having had a bit of a rise, they're consolidating. They've come back a little bit. They will go higher again. And as they go higher, the whole of the credit, the gigantic credit system will come under threat. And the first thing we'll see is that there will be a massive bear market in equities. Lots and lots of money will be lost. And I think we'll also see cryptocurrencies come down as well, because crypto are correlating very nicely with the Magnificent Seven tech stocks. It's quite clear that the people who've been gambling in Bitcoin are the same people who gamble in those stocks. It's like a tech stock, if you like. So I think we're going to see that. That's going to be the first sign of it. But rising interest rates, rising bond yields are basically going to undo government finances big time, because governments, and particularly the United States, with a debt to, with a debt to GDP of around about 125, 130%. And the economy is not being productive. This is the other thing, Lucian. The Congressional Budget Office came out with figures earlier this month. Is estimates for GDP and for the deficit. What we're looking at, I mean, realistically, the deficit is going to be about 8% of GDP. They reckon that GDP will grow by 4.5%. Virtually all the deficit is spent into GDP. So what we're seeing is, if you take the government spending out of GDP, the private sector is actually contracting in America. So this is actually, you do the same sum with most of the other G7 nations, and you'll find that France in particular, bad news. Britain, bad news. Italy, bad news. I mean, this is everywhere where you've got these deficits, these nations are going into debt traps, and the biggest debt trap of all is the dollar debt trap, and it's that that's going to unwind the entire credit bubble. Commodities have started to rise, and it's really where the flows of credit go. That's the key to it. So, I mean, the credit has been going into financial instruments. It's been going into equities. It's been going into government bonds, all that sort of stuff, and not into commodities. So, but that is now changing. And I think this last year we saw commodities rise roughly 18% or a figure like that, somewhere between 15 and 20%. Gold, of course, rose by more than that, about 24, 25%. So, we're seeing things turn around. And a lot of that is not so much demand for commodities, but the declining purchasing power of currencies. Which are credit. I mean, the top level of credit is a currency. So I would expect to see commodity values measured in these currencies increasing over next year.
Yeah, can we add to the list of bubble dangers? Okay, we have crypto, we have stock market, we have credit. Can we join real estate on the list as well?
Well, both commercial and real estate will be undermined by rising mortgage costs, rising finance costs, if you like. They're being seen very much as an extremely profitable investment over long periods of time. And I think that there's still that sentiment that, if you've got bricks and mortar, as they put it in English, you're safe with bricks and mortar. In other words, it's tangible, it's real, and it's not some airy-fairy funny share or whatever. So, you've got that sentiment. But the problem is that the pricing of property does depend on the availability of finance and the cost of that finance. And if the cost of the finance rises, then obviously that's going to impact negatively on property prices. So I think that is also something that's going to happen. So, that's going to be no safe haven, I'm afraid. I think, well, I don't know. It's going to slow down very rapidly, that's for sure. I think I wouldn't rule out a crash, because as soon as people begin to realize that interest rates are going to go up. I mean, at the moment, apparently, one further cut is discounted in the Fed funds rate is expected in the market later on this year. I mean, that's changed from two in this year. They're now expecting one in the third quarter, apparently. That's going to go. That's not going to happen. And when people realize this, and I think probably when you see the 10-year US Treasury yield more than 5%, everybody's going to alarm bells. And I think that's going to start collapsing the equity market. And I think the collapse actually could be very, very quick because everybody is in there. They're in there up to their necks, and more leveraged as well. And of course, the other thing is that all this stuff is the collateral for the banking system. And the Fed is going to be in a quandary because under those circumstances, it would want to cut interest rates. I mean, every time a bubble has sort of started rolling over, the Fed has cut. But this time it can't. It's not going to succeed. I mean, if it cuts interest rates, the initial consequence may not be fully understood by people. But the effect on the purchasing power of the currency will be anticipated by gold. That is for sure. Gold will, measured in any currency terms, go far higher. But actually what's happening is it's not gold going up, it's currencies going down. And then you will see that, the inflation problem is just getting worse and worse and worse. There will be a shift, I think, out of industrial and tech stocks into mining stocks. And that, again, I think is likely to sort of, if you like, create problems, the move of capital out of equity markets into commodities, if you like, and commodity producers. I think is going to exacerbate the problem. But that's, investment managers are going to realize that under these circumstances, that is the place to be, not in equities. So you could see the switch happening really quite quickly.